Good morning, good evening, good afternoon, wherever you are in the world. Hope everybody is doing well and you're avoiding this coronavirus illness. Um, Real quick, just going to do my thoughts and analysis here for the overall US market. Just completed a trip to Central Europe. Been here for a couple of weeks, have no signs of illness. I feel perfectly fine. And with that said, I feel blessed to have not been infected and not affected by this illness that's going around. But it also leads me to believe that it's not as rampant as the mass media is making it out to be. So, with that said, I'm not going to go into my opinions of the mass media and their fear mongering and all the nonsense they're spewing, but do your own research, put your own thesis into place, and move forward from there. My thoughts and prayers go out to those that are affected by this, and hopefully, everybody sees a speedy recovery. Now, real quick here, my main question, now that I'm settling back down and looking back at the markets and getting back to actively trading, my main question becomes, what was the reason, the overall, the real reason for this market sell-off? In December, if you are a member of the trade room, I was talking about how the average PE ratio for the S&P 500 was getting stretched. We were over 21, 22, and tagged right around 23 in February. Those are, or that is a historic average at which point there's usually been a sell-off in the market. The same thing happened back here in 2018. PE ratios just get stretched, and it's time for big money to no longer be put to use. I mean, not permanently, of course, but there's no reason for big money to continue to buy something at such a high valuation. And now that we've had a pullback, I think some big money is being put back to use. I mean, you had a huge bounce here on Friday. Of course, Trump had his meeting and all the major companies that are going to help participate in getting the coronavirus testing out and all that good stuff. So that it seems like the market wanted to hear that they had some sort of a plan in place. They do now, so hopefully things do start to settle down and we form some sort of a base. Now, in my opinion, the market is not going to completely crash like all the bears are calling for. May have seen the worst of it. Now, there's going to be more cases of this virus going around there. That's a given. But now that everything seems to be under control, we look at the timing of things. China notified the world that their outbreak started back here in December. You look at the chart here in December, our markets did not care. So back to my main question, was the coronavirus the cause for this sell-off? Yes and no to an extent. No, because valuations were just simply high. As I've said maybe 100, 200 times in my videos, the S&P 500 is a vehicle designed to go up through rebalancing. There's a constant flow of money into the S&P 500. You look at IRA contributions, 401ks, those weekly, biweekly, and monthly contributions. There's always a plethora of buying into this vehicle. You also have pension funds that want to be exposed to this. If you're not an active trader and you're not an active investor, this is the best way to put your money to work. So for that reason, it is designed to go up, and if it didn't work, participants would not be buying this. Now that more and more information does become available for financial decisions, there are more informed investors, much more than in the 80s, the 70s, the 60s, and further back in history. So for those reasons, I believe there's going to be a lot of calm, cool, level-headed participants that say this is more than likely another buying opportunity, and they're putting their money to use. So with that said, here's where the coronavirus outbreak was alerted in the world in December. We're now here in March. As of this, I believe it was the beginning of this past week, China said their emergency hospitals that they built have now been shut down, implying there's no need for them. They have it under control. They're sending their research and medical teams to other countries. They just sent a huge team to Italy to help out with their outbreak, along with 30-some million tons of medical supplies. Now that they have a handle on it, it's only a matter of time until everybody else in the world has a handle on it, and it's great to see countries working together to really fight this thing and get things back to quote unquote normal. So with that said, now that we are starting to have larger outbreaks in the U.S., I would expect it to be a couple more months maybe until it's officially under control and they have more steps in place to not only test but to also treat this virus. And we get more as we get more data out of these reporting agencies, we'll see the mortality rate continue to fall. Simple as that. It's I'm trying to avoid not saying I'm trying to avoid saying that it's like the flu. I know that's going to strike a chord with a lot of people, but in reality, there are far more things that have a much higher mortality rate, but a much lower frequency of occurrence in people. I mean, driving down the road, getting struck by lightning. I mean, there's all kinds of things that we don't avoid in our day-to-day lives. That a virus shouldn't be one of those things that change our way of life permanently. So with that said, I say another 2, maybe 3 months until we start to see some more color from companies that report their earnings as far as the financial and economic impact of this virus. Now, of course, there is going to be a slowdown, at least for the near term. I would say 1, maybe 2 quarters, 3 maximum. This is just my opinion. But now that we're seeing all of this stuff come under control, growth will continue and we'll get back to what the market was doing, and that was climbing to all-time highs. Now, do we see it within 2, 3, 4, 5, 6 months? I'm really not sure, but what I am sure of in 5, 6, 7, 8 quarters from now, this coronavirus will be well in the rearview mirror and way behind us, and the market will continue to do its thing. The best thing for me to do, what I have been doing this weekend in the past few days, is looking for companies, looking for businesses that have been performing well, that even though they're going to have some sort of an impact from this virus, they were still continuing to grow prior to this outbreak. Looking at companies that were raising guidance, their revenues continued to grow, they found ways to penetrate new markets, they were creating new products. All this stuff leads to a stronger balance sheet and stronger earnings reports going forward. So with that said, banks are my favorite. A lot of them came down to much more realistic investable levels, paying very, very nice dividends. I am not an investment advisor, so take anything I say as entertainment only, and do your own research before you put your money to work, because nobody else will do that for you. But a lot of banks did come down to under an 8 PE. Some of them actually broke under 7. A few of the smaller regional banks started paying over 5, 6% dividends. A couple of them came close to a 7%. So there are plenty of opportunities to buy stocks in this current drop. And as a lot of my colleagues have been saying, I'm going to say as well, things are looking good again. Big money is going to be put to work, and this is only a couple of quarter impact on the grand scheme of the overall world economic state. So the world is not going to end. Coronavirus is not going to wipe out a mass percentage of the world. Again, I'm trying to avoid talking about the mass media. But this is not going to be a permanent issue. Now, the illness will always be around, just like HIV, Ebola is still around, swine flu, bird flu, all that stuff is still around. But even during those major outbreaks, the market has significantly recovered and gotten over it. It's as simple as that. Yes, things are scary for a little while. But again, as I said in the beginning of this video, this market was simply overvalued. Now, I'm going to go and touch on my favorite, or at least the largest sectors for the S&P 500 and take a look at what they have been doing. First of all, I do want to touch on transports, because if you follow my videos, I am a huge follower of Dow theory, and transports theoretically lead the market. So here we see IYT, which is the transportation ETF, failed to make a new all-time high, while the market, the S&P 500, was able to. Once it started to sell off, we started hearing about coronavirus back here. January was not very good. February was not very good. In March, we broke this very well-defined channel to the downside. And with the impact on a lot of the transportation names as far as airlines, cruise, and that kind of stuff, of course, that's going to impact transports. Now we have people under quarantine, cities being shut down. So again, that's going to impact a lot of the trucking industries, the railways, and that sort of stuff. So it's realistic to expect transports to be hit the worst. But once this all blows over, which it will, these are going to rebound. Now, at the end of February, I was looking at some of my favorite trucking names, being JB Hunt, Schneider, and Roadway. But once this broke, I was also in the middle of some traveling. I have not bought any yet. But they are going to be very nice opportunities. If you go and look at UPS and FedEx, they had tremendous bounces on Friday. Those are probably going to be my go-to coming into this next week. As I keep saying over and over again, this will pass and we will get back to a period of growth. It just may take, one or two, in my opinion, 3 quarters at max. Onto financials, you can see here the XLF, which is the financial ETF, came off about 40% from the recent highs. And again, banks are looking very, very good as far as an opportunity to put some money to use. And again, do your own due diligence. I personally have put some money to work in some financials, and hopefully it works out. If it doesn't, then my risk is controlled. I will probably add below, add on any moves down in my favorite banks. But right now, as I zoom out here, I ask myself, is the world economy, is the global economy, is the U.S. economy worse off now than we were in 2018 or 2017 or even 2016? Because that's essentially what this chart is at least implying, that banks are possibly in a worse case or worse scenario than those time frames, and I don't believe that they are. And of course, by valuation standards, they do look very nice and investable. So even though this was a technical double top, fundamentals ultimately drive big funds and big money in the market. So if things do look like they are buyable, they probably are going to be so on a fundamental level. Now on to technology. Technology PE ratios generally are higher than other sectors of the markets. But again, this is something that has also come off about 30%, I believe. So this looks like big money is being put to use. Every significantly large red drop here you can see on a monthly basis has been bought. I mean, even this one here, even back here in the 2008 housing crisis, or excuse me, housing crash, was down for 3 months before it started rallying. We see that massive bottom we had back there. We're not in a dot-com bubble type scenario. PE ratios are not in the hundreds and thousands. So for those reasons, technology is not looking that bad either. The 3 major individual stocks I want to touch on here are Amazon, Apple, and Microsoft, because they are the market leaders. I mean, they have the they have the largest weighting in the S&P 500, and it's good to keep an eye on what they are doing as far as a potential influence to the S&P 500. So have a little bit of a pattern here that's drawn, just I'm going to call it a bull wedge, whatever. It's just some lines that I drew on the chart. They really mean absolutely nothing. But came down into the range of a consolidation where I was buying calls, and through all this move, caught some of this pop up here, and then it just absolutely exploded. So as I zoom out here to the monthly chart, February does actually look like we are at a potential top. Now, one argument that I have against that is we put in the original resistance here, tested, put in a higher low, actually broke above it. Now, either this is a false breakout and we continue to flush and it reverses all the way back down like some stocks do. I don't believe that's going to happen because this is Amazon. They are growing immensely. They're going to be a huge beneficiary of what's going on with the coronavirus because people don't want to leave home. They're able to buy stuff through Amazon. Now, granted, they may not be delivering as much as they have, and if you go and try to put in an order, you'll see due to high demand, they cannot provide the same-day delivery kind of stuff that they have been before. So consumers are just eating up Amazon, and it's going to rebound in my opinion. And I am in some Amazon now, and we'll see what happens. I'm looking forward to at least get back up here to 2200-ish area before I sell it. So on to Apple, which is another monster in the market, closing, I believe, all of their US stores or whatever. I have some lines on here just to illustrate that Apple does have these large drawdowns, and it is fairly quote-unquote normal, 45%, 31%, 39%, and currently 24% from all-time highs. So Apple is another company that continues to find ways to grow, penetrate new markets, create new products, and of course generate a shit ton of cash. So um, Apple should be fine in my opinion. Does it come down a little bit more? Possibly. But again, it's not a world-ending event, and people are not going to stop completely buying Apple products. Microsoft, I could say the same thing about them. Microsoft came off about 25%. Looks like it came down, tested this 2018-2019 consolidation range. And I posed the same question regarding Microsoft as I did in financials. Are we in a better or worse economic scenario than we were at this point in time? And to me, I just think that's a kind of a no-brainer. Microsoft is one of those companies that, again, continues to grow, continues to reach new customers, and continues to build their balance sheet and their revenue. So I'm looking at all of these significant drops as tremendous buying opportunities and not a reason to really let fear in the markets take hold of me. So with all that said, I hope everybody has a good weekend. I will begin doing these weekly review videos again now that I can get back to actively trading. And if the volatility stays high, there's going to be a lot of tremendous trading opportunities. So stay safe out there. Have a good weekend. Spend some time with your family, and we'll see what happens next week.